Lance Roberts with 3 minutes on markets and money. It is Tuesday, of course, and we're actually working our way through the month of July, despite the fact that the markets had this massive June rally. It actually didn't even recover the actual losses back in May, which was also one of the largest losses for a month on record as well. So the market's really just been traveling sideways now for a while. We've made a little bit of gains here just recently, breaking out to all-time highs earlier last week. But the question will be whether or not we can hold on to those gains. Markets were weak yesterday. In our newsletter this past weekend, we actually said that we'd likely get a correction this week because the markets had gotten kind of ahead of themselves. We were going through that correction yesterday on the markets, of course, seeing a little bit of weakness this morning here as we get ready to open as well. We haven't really solved anything, right? At this point, we still don't have any issue on trade. Of course, the Federal Reserve due to meet later this month. And of course, the question is, are they going to cut rates? It's hard to suggest they're going to cut rates much, maybe a quarter point just to appease the markets. But really, outside of looking at the actual economic data, services still remain fairly robust. They are weakening a bit, but they are still in expansionary territory. Manufacturing is a little bit weaker, but employment is still strong. So from the Fed mandate standpoint, which is basically maintaining price stability and full employment, there's really not a lot of reason to cut here outside of political pressure. But there's a risk here by the end of the month the Fed could disappoint the markets. The issue becomes the fact that we do have this previous high back in May. We are a little bit above that. If we fall back below that, we're simply going to fall back into this big trading range that we've been in now for the last 18 months. We do have some good support right around the 200-day moving average. Below that, it does start to get dicey because we're going to be talking about retesting the lows from last December. On a short-term basis, we got overbought. That started getting worked off yesterday with the sell-off. But again, when we move out to a weekly or a monthly basis, we are currently still more overbought now than we have been at previous market peaks. And again, a correctional move here in the markets to work off some of that overbought condition would not be surprising. What would coincide with that, of course, would be disappointment from the Fed, lack of any forward movement on trade wars. And again, that's something that's a very real possibility because with this current administration, we've said that China is not going to give up a lot of their positioning over a president that's only in office for four or five more years. They've got a 50-year outlook, and they're not going to agree to a deal that's bad for them long-term just to appease a short-term need in the markets. And don't think that this point is lost on President Xi with the Chinese government, that we are in an election cycle. Economic pressure on the U.S. at this point will affect the re-election of politicians. So if economic weakness continues to pick up, there's going to be more and more pressure on the president to relent on this trade war. While it might be dictated to win short term, the markets are going to understand what happens. So again, this is an issue that is not being resolved anytime soon and will potentially put more pressure on markets. And also pay attention to what they say about consumer spending. Inventories are building, which suggests that consumer spending is slowing, and that's going to potentially put more pressure on stock prices as we move forward. Technically speaking, Tuesday, it's on the website now, realinvestmentadvice.com. We'll keep you updated right here at 3 minutes on markets and money. I'm your host, Lance Roberts, realinvestmentadvice.com.